Hello, chart watchers, and welcome to this Thursday, December 20th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, it is the day after the Fed meeting, and you can see the market not reacting very well to what Fed Chair Jerome Powell had to say yesterday. Dow Jones Industrial Average tacking on further losses to yesterday, down 334 points today. The S&P 500 down another 32. The NASDAQ down 112, and the small cap Russell 2000 at the low of the day down 23 points. 10-year Treasury yield continues to move lower as money rotates into the defensive Treasury market. Volatility index on the rise. And as a short-term trader, this is one chart I'm watching closely. I don't want any part of the market when the volatility is up like this. Never know how far the market will drop. All I know is when we see it rising like this, we get a lot of impulsive selling, and that's what we have right now. Utilities bouncing, the only group in positive territory, holding on to recent lows. Not looking particularly good, but at least on a relative basis, holding up better than other areas. Recreational products, a worst performing industry group, as you can see, down about 5, maybe close to 6% now. A couple of earnings coming out very weak. Carnival Corp came out with their earnings, big gap down here, down almost 10%. Accenture and Conagra Foods, or Conagra Brands, both dropping after their earnings reports. Biggest drop in the S&P 500, though, belongs to Twitter. We are seeing more than a 12% drop in Twitter, going back down, perhaps to test its gap higher that we saw back in October. All right, Aaron, we are almost 24 hours past Fed Chair Jerome Powell's comments, and I don't know. I don't know if he was trying to be independent just to show his independence, but he didn't really back off of the hawkish tone that's been set throughout 2018. Market didn't react very nicely to it either. There was a big reversal in the market at 2 o'clock yesterday. I don't know. What do you think?
Yeah. No, it was surprising to see. I had hoped that, I think everybody had hoped that it would come in with a little more, softer language, just to maybe boost the market going into the final trading of the year, but no such luck. Are you ready to call it bear market yet, Tom?
Yes, I've called it.
Okay, good.
Yep. I mean, for me, the difference between a bear market and a correction is not that different. It's really whether or not you get the price breakdown. So they both are accompanied by extreme volatility. They're both accompanied with these impulsive sell-offs. The question is whether or not you create that series of lower lows and lower highs. So that's really the only thing I was waiting for to confirm. I mean, the way the market looked back in February when we dropped, there was no doubt in my mind that was not the start of a bear market. That's not usually how the bear market starts. It's a process that we go through, and I think we've gone through that in 2018. We've seen a lot of the rotation. You've talked about it a lot on here, Aaron, and a lot of that rotation has been to defensive areas of the market, which is not what you want to see. The last 2 or 3 months, I mean, things have really broken down in a number of key areas, but we can get into all that in a bit. I do want to welcome in our guest today, Julius de Kempenaer. We always have such a great time when Julius joins the show, so welcome, Julius.
Thank you very much, Tom. Hi, Aaron.
Hello.
What did you think about the Fed yesterday, Julius? Any comments?
What happened?
Oh, did something happen yesterday afternoon?
I'm far away from all of that. No, I mean, yeah, that was not a very nice Christmas present from the Fed. Let's just put it like that. And it's something that we have to deal with. I view events like this as, to stay in baseball terms, Tom, that you were teaching me so right. This is one of the other curveballs that were being thrown as analysts and participants in the market, and we just have to deal with it.
Yeah, yes. I like the fact that you're picking up these baseball terms from me. Were you going to say something, Aaron?
No, I'm just listening.
Yeah. You say that, I know you were joking, that you're kind of far away from it because, of course, whatever the Fed does is going to be felt across the globe.
Oh, and yeah.
Look, at the European markets today, they're all down as a result. Overnight, the Nikkei got hit, I don't know, close to 3%, down almost 600 points. Hang Seng was down 250 points. I mean, there's repercussions everywhere.
Of course. I mean, there's no secret and there's no doubt that the U.S. market is still leading the rest of the world. I mean, there's a lot of people who want to believe otherwise, but days like this, you see that, something happens in the US, it ripples down through the rest of the market. We're all related.
Yeah, no doubt about it. We also got oil down another 4% today, $46 a barrel. I mean, things are just falling apart as we speak, but we're going to get into all this. Hang in there, Julius. We're going to bring you back about 15 minutes or so. I know you got.
I'm not going anywhere.
All right.
All right. Oh, and I do want to tell our viewers, because I told everyone I'm completely in cash now, just so everybody knows, because I told them I would let them know. So
are you going to mark? Are you going to mark a short-term bottom?
Today, once it got up to almost yesterday's close, I just went ahead and pulled the trigger. So
yeah,
I feel pretty good about it, actually. And I'm prepared. If the train does leave the station on a bounce, hey, I can hop on. I just will miss the first part of the journey. Nice. All right, upcoming schedule.
That's all right. I was just going to say, I suspect we'll probably get a short-term bounce, but I don't think it'll last very long. And the other thing I wanted to mention is that Julius has agreed to stick around with us for the final segments, which Erin will go over with you in just a second.
Yep. So tomorrow, Mary Ellen will be in for me, and what's hot, what's not. We have no live shows. We're going on Christmas break after Friday, and then you will see us in January. So happy holidays, because I won't be here tomorrow on this show. Today's agenda, a helicopter view using RRG. Julius is going to cover that. First 10 and 10 symbol is going to be United Rentals. And finally, we're going to finish off with Sound Off. And we'll discuss the rules on that, but it'll be a fast-paced segment. You'll want to stick around for it. All right, Tom, technical news and headlines. Away we go.
All right, let's start with the economic reports. Initial jobless claims, not bad. 214,000 came in. The expectation was 220,000, so a little bit of a positive surprise there. December Philadelphia Fed survey, though, came in at 9.4, short of the 16.5, so not a good number there. November leading indicators on the surface looks pretty good there, rising 0.2% when we were expecting a flat reading. However, October's, which is not showing up on your screen, was revised from a positive 0.1% to a negative 0.3%. So net on that report, I would say, was probably a little bit negative. And of course, one of the things impacting leading indicators is the U.S. stock market, and that has not been very strong, as we all know. It's been very weak. So anyhow, taking a look at the Treasury market and how it is reacting to these reports and to the Fed yesterday, you can see that the 10-year Treasury yield currently down to 2.76%. I don't know where the floor is. Hopefully we are getting close to it here in the low 270s, because if that fails, this was a straight up move with not a whole lot of support as I look down below, say, 271, 272. Probably we would want to maybe take a look at the weekly chart. And on the weekly chart, we had this double top breakout at 2.60%. But by the time we get down to 2.60%, that's a lot of money continuing to rotate into treasuries. And that's a lot of money probably it's coming out of the equity markets. Could send the markets quite a bit lower. So we'll want to keep an eye on this for sure. There were a number of earnings reports out last night, or actually this morning. And so let's go ahead and take a look at those. You can see on your screen, all four of these companies beat on their bottom line. And I'm going to show you some charts. And all four of them are getting their heads handed to them today in the market, which is not a good thing. So good earnings report. This is a really a good lesson in fundamentals versus technicals, because fundamentalists are getting up, looking at these earnings reports and wondering what in the heck is wrong. Why are their stocks dropping? Let's take a look at Accenture. Accenture, here's the move. Now, in terms of their earnings, Accenture had the beat of 1.96 versus 1.84 in terms of earnings. But look at the stock's reaction here. I didn't see I was trying to find the guidance on Accenture. I'm not sure if they guided lower or not, but you can see clearly this is a breakdown on Accenture. Not good at all. I'm going to go ahead and, for these earnings reports, pull up the relative strength of the stocks versus their groups. Accenture actually kind of surprising, because this was a stock that was outperforming its group. The problem is the group is really weak and had broken to new 52-week lows heading into the report. So breaking down below the March-April low, not good here for ACN. Next up, Walgreens Boots Alliance, WBA. You can see I'm pretty sure that this stock had a negative divergence on this high. I know the overall drug retailers had a negative divergence, but the selling here over the past 4 or 5 days has been brutal. And now with their earnings, by the way, they missed on their top line. They beat on the bottom line, missed on the top line. They reaffirmed fiscal year 19 guidance, and this is what we get to the downside. The whole group falling apart. This is a stock actually relative to its group's been pretty strong, but look at the tumble that we have seen in the drug retailers. Not good. Carnival Corp, CCL. You can see here that it is broken to new lows. Its group has broken to new lows. Really was not a very good performer relative to its peers heading into its earnings report. They matched top line estimate. They beat by a penny on the bottom line, but they lowered their Q1 earnings per share guidance, and we're starting to see more and more of this, including the next stock, Conagra Brands, CAG. They missed on their top line, as you saw on your slide. They beat on the bottom line, 67 cents versus 55. But look at this. So a fundamentalist says, what the heck? What's the matter? Company just reported blowout earnings. Well, part of the problem is the market looks ahead, and Conagra lowered their fiscal year 19 earnings per share guidance. So now the stock has fallen from 37 down to 25. This breakdown in here and this move lower the last couple of months was our warning that this was not going to be a good outlook going forward. That's why technical analysis is so important in what we do. All right, let's take a look at, I'm going to pull up this equity put call ratio. This goes back the last 24 months. And what I've done here at the top, this is the equity only put call ratio. It's a sentiment indicator similar to the VIX. It tells us when things are, getting too out of hand to one side or the other. Everybody is going in on one side, and when everybody gets in on one side, usually we get a reversal. I do want to point out that this equity put call ratio here is currently at 0.76. That's a 10-day moving average. So this chart is a 10-day moving average. I want to show you the last 2 times we saw a 10-day moving average get here. You can see that in August we bounced, and then last month we had a nice little bounce. So I do think that we're getting close to an area where we're going to bounce, but the problem is we've already seen a big volume breakdown. Check out the S&P 500, not only taking out the recent lows, but also taking out the double bottom from earlier in the year. So yes, things are getting a little pessimistic. We're probably going to get a short-term bounce, but if you're someone who likes to short, I would be waiting for that bounce, and I'd probably be licking my chops waiting for the next bounce, because I do think it's going to be short-lived. I think we're going to roll back over to the downside, unfortunately. As I said to Aaron earlier, I think we are looking at a bear market. I think it's been confirmed. That breakdown here this week, to me, takes this correction to the next level. All right, Aaron, there's so much we could talk about, but I know you've got some upgrades and downgrades, a host of them. So what do you got?
Yes, let's get started right now. I'm going to go over 7, so we're going to move through pretty quickly here. All right, Avalon Bay was upgraded today from a hold to a buy. And what I went ahead and did is looked at this, and as I was drawing in these support levels, I noticed, wow, that looks like it could end up being Fibonacci. So I figured I'd just give it a try. I don't generally use the tool, but look at how it lined up. It's pretty amazing. The top here was at the highest close. You can see this comes in right on these tops. The next line covers that support level, and then finally we're down here. So this is where I would be looking for the stock to go, and you can see it also lines up back here with the tops in July. So I'm not looking at this as an upgrade. I've got a PMO sell signal. I think it's pretty ugly. And honestly, I'm going to tell you, all these charts are pretty ugly. So whether upgrade or downgrade, to me, it just doesn't matter right now. All right, let's make that bigger. I went ahead and marked the support based on the close back here that we got. And it's interesting when you see the lowest close back here in 2016, we're down below it right now, and we are trading below it. So I am looking for a move down to that $25 level on Halliburton. And if we go and take a look on the monthly chart, there you go. I think that that's reasonable, but if that goes away, oh man, I don't see support until really you get all the way down here in that $10 to $12 range. So hopefully not that, but again, I'm not so sure about that upgrade unless you want to look for it to bounce at the $25 level. Humana was upgraded today by JP Morgan from neutral to overweight. And, you know, it dropped through its support already a couple days ago. Now it's headed toward this next area, which matches up with these tops back in March, as well as the lows in May. PMO, ugly. It is oversold, but let's face it, look in the thumbnail. We're not even seeing any deceleration on that one. Not good. Phillips 66. Now, with a lot of these charts, as I was going through them, they busted through the support for the year. So whenever that happens, I, of course, go to the weekly chart to see where my support levels are. Right now, you can see the PMO on the daily chart is very oversold, but it's been very flat during this decline. It doesn't show me much here. The volume is pretty ugly, going the wrong way. And of course, the scooter is not where you'd want to see it. So if we take Phillips 66 to the weekly chart, what is it telling us right now? Well, like I said, very important support, broken. And look at how it lines up all the way back to that 2015 high. And we're breaking down below that. If I were a technician, I would not be upgrading this stock. So I would be looking for it to make a move all the way down here, the 70 area. You know, this has not been a particularly strong area in the market, but apparently Jefferies thinks it's going to be as it moved Phillips from a hold to a buy. All right, let's look at a few downgrades here. The first one is Anadarko Petroleum. And I do want to say that Capital One got in there, and like yesterday, we had all the REITs by JP Morgan upgraded, downgraded. Today, it's all the energy stocks. Capital One was upgrading and downgrading those. So just an interesting fact for you. Clearly a problem stock right now, and Anadarko. But you know what? With oil, I mean, this is all making a lot of sense. We do have a PMO in oversold territory, but no deceleration yet. OBV has now left the lows that we had seen over the past month and is now lower. And in fact, if you come back, it's starting to hit lows we haven't seen since all the way back here in April. But where's our support level? We can't see it on this chart, so we got to bring it to the weekly. All right, support level, $40. Pretty clear. You've got, again, those even numbers tend to be psychological support and resistance anyway. So I think that's excellent to consider for your support and resistance. Right now, this $45 level, you can see that those lows back in October have now been busted. So really what I would be looking for, like I said, trip down to the $40 level on the downgrade here. Chesapeake Energy downgraded by Capital One from overweight to underweight. And again, another one hitting lows for the year. So we go back over here to the weekly chart to take a peek. And wow, the lows are, well, quite low. We're looking at about $1. This one's already trading under $2. So, you know, the volatility and all of that, I'd just be very careful with this, because it's broken down now between, you know, below some really, you know, important support levels. And now we're headed down to $1 on this stock. So just, you know, keep your eyes open. And then finally, we'll look at Devon Energy. My daughter's middle name, Devon. Okay, so again, another one where we can't find support on the daily chart. So we go to the weekly, and we're looking at the same sort of picture as we were on Chesapeake, only the pricing is a little bit different. I see the lowest close is down here from 2016, just above 1750. I suspect that's right at about $18. That's where I'd be watching Devon Energy. I believe that that's where it's going to go. All of these charts are pretty ugly, and let's face it, we're bear market time, you know, Julius, and a lot of these charts are going to look pretty ugly. So tell us, I want that helicopter view. It sounds very interesting.
You're going to
Help
get
me
it.
out here. So yes, there's the summary though of our upgrades and downgrades. Some of the others that I didn't go over: Fiserv was upgraded, Kinder Morgan, Pivotal Software, and HSBC Holdings was also downgraded. So now take it away.
Yeah, interesting. Well, I was listening to your talk and going over all the charts. The phrase that because you had to switch to your weeklies to find support.
Yes.
And I just jotted down this saying that we shouldn't confuse the bottom of the chart with support. You know, when a lot of people in their minds, when a chart just hits the lower part of the panel, that's just a software that said, okay, this is a good way to cut off my price axis, but that is not necessarily support. So so that was funny. Mm-hmm. And what I also noted was that, we have the stock charts TV logo in the bottom right of the corner, and that was no problem because the charts were all going up. They were going from the bottom left to the top right, but now they're all going from the top left to the bottom right. So I think we should move the logo to maybe the bottom left part of the chart or something like that. So
until we get to that bull market, right?
Yeah, we have to talk to the producers for that.
Hey, Julius, all you got to do is just flip your monitor.
Oh my God!
Turn it over, and everything lines up beautifully. We're still in a bull market.
It's right.
Okay. Yeah, you go. Yeah, that's a good one, Tom. That's a good one, actually. Hey, when stuff like this happens, I always try to take a little bit. My view is generally a little bit longer term than other people who are very active, but especially when you have all this turmoil going on in the market, I find it, for myself at least, a good thing to step away and take a little bit, take a look at the market from a distance. So what's really going on? And for today, I want to talk you through a top-down view using obviously the RRG charts, and then dive into some individual charts. I'm gonna talk about the asset allocation. I'm gonna talk about the benchmark that we're using. I want to talk about the bond stock rotation. Have a quick look at the individual sectors, and then I'm going to pick two sectors that I really still like, I should say, at the moment, and two sectors that are really, really bad in my opinion. And then in each sector, I'm going to pick one stock, or in the good sectors, I'm going to pick one stock that I think will continue to do well, and in the bad sectors, I'm going to pick two stocks that I think will continue to deteriorate. So on the left side of your screen, you see the RRG for asset allocations. That's a predefined group that we have on the RRG page. It's just the top one. It says asset allocation. It lists a number of asset classes, and we use VBINX. That is a Vanguard Balanced Index Fund that tracks a balanced portfolio that consists of 60% in equities and 40% in bonds. And by the way, the bond part is spread out over government bonds and corporate bonds as well. If you look at this RRG, I mean, that sends a pretty clear message. I mean, I've been using this chart for a while, and it's been sending this message, but right now, for the past few weeks, it became even more imminent. There is only one asset class in the lower left-hand lagging corner, and everybody else is in the top right-hand leading quadrant. And the one that's in the lagging quadrant is the one that we least want to see there. That's the stock market. That's SPY. To add to the problem is that it is continuing lower on both axes with what we call a negative RRG heading, which is between 180 and 270 degrees, moving in this direction. So southwest for you sailors or pilots or whatever you are, like on a compass. And because the benchmark consists of 60% equities and 40% bonds, pretty much everything else is moving on the other side, the other direction. So we've got government bonds here, 7 to 10 year government bonds. This is the US dollar index. This is real estate, VNQ. That's the Vanguard Real Estate Fund. We got high yield and we got corporate bonds. And the one that you see turning here is commodities. It's a little bit disappointing. I had expected a little bit more, but commodities are already starting to send negative signals just after entering the leading quadrant. The most important message here is that all the fixed income related stuff is moving to the top right, and stocks are moving to the bottom left. So that is not a good sign for stocks. Now, it doesn't mean that everything here is showing positive returns. The only thing it says is that the returns here are better than VBINX and especially SPY on a relative basis. So a good thing is to have a look at the VBINX chart. I'm sure we don't do that a lot, but for this occasion, I think it makes sense because this is the VBINX balanced portfolio, and we've seen this massive uptrend all the way up. We broke that in the beginning of October, moved a little bit sideways, a little bit, jumping back and forth between support and resistance. And last week we broke below that slightly rising support line, and now we're gapping lower. So that is not a good chart. It means that our balanced portfolio is going down. So if you're an advisor or if your portfolio is a balanced portfolio, your return is now going down. It means that if you look at the left-hand side, that your bond holdings are going less down than the rest. As a matter of fact, bonds are going a little bit higher. Commodities, for example, are still going down, but they're going down less fast than stocks. Now, translate that to a relative picture. Here we have VBINX versus SPY, and if this one goes down, stocks do better than the balance, so stocks are outperforming, and now it's turning up, so stocks started outperforming, and that process started a couple of weeks ago. Bottom line, equities are not good now, and they don't look very good for the next couple of weeks. Time horizon, very, very difficult. I've always used as a gauge, as a rule of thumb in all my work, when using weekly RRGs and weekly RRG lines, that trend changes like this should last a minimum of 3 months. So I always told my people that you don't need to read my stuff the same day. The same week is good, and even the next week you should be okay, because the trends that I'm trying to call usually last a minimum of 3 months, but very often they last much, much longer. Now, if we dive into some sector stuff, so we had the asset allocation bit here. If we move to the sector ETFs, that is a pretty interesting picture as well at the moment. We got a ton of stuff in the top right-hand corner. That's real estate, it's utilities, it's staples, and it's healthcare. Typically your defensive sectors. In my RRG blog, I've mentioned and written about these defensive moves, these rotation to defensive sectors a number of times over the past couple of weeks. And that picture is still going on. You can see that the rotation is still valid. It's still going there. If you go back, you see the rotation of all these defensive stuffs going there. We see healthcare and staples rolling over slightly. It's not the best that we can see, but if you look at the level where they are compared to 100, 104, these are relatively high RS ratio levels, which makes the possibility for a turn on the right-hand side, so the odds for that are quite large. So, for staples and even for healthcare, these are technically still relative uptrends. They are just losing some relative momentum at the moment. If you look at what's going on in the market right now, and if you look at how far they are away from the center of the chart, I'm still not too worried. So that's for the defensive stuff. If we move over to the left-hand side, we see materials and financials in the improving quadrant. Financials already hooking down right now, so that's not very good. Materials moving a little bit higher, but just like these defensives are at very high RS ratio levels, materials is at very low RS ratio levels. So it takes a lot of strength before a sector like materials will be able to move all the way over to leading. So I'll be very reluctant to call this. Maybe it's a little bit of a short-term bounce, but that's about it. Communication services, that new sector is improving, but still very low. We've got discretionary here, and we've got technology here. We got industrials going down, and we got energy going down. And again, if you look at the rotation of those, scroll back, you see that industrials, they are here. If we track that rotation down, you see that it's turning before it manages to reach the leading quadrant, and now drops back into lagging, meaning that it's starting the second leg of its downtrend, which is not strong. And if we go at energy, it's, well, probably even worse, because it entered the lagging quadrant, started to move higher a little bit, bouncing up, and then all of a sudden it hooked left and started to deteriorate again. Now, we all know that it should theoretically rotate in a clockwise fashion. If on a weekly RRG you see a hook like this, it means that on the dailies or any shorter term time frame, we have seen a rotation clockwise, but that was just so fast that the weekly time frame is too slow to pick that up, and that's why it creates these hooks, as I call them. So defensive is still what we're looking for. Now let me go into a number of these charts. The one that I needed to talk to you about, I went too quickly, is the relationship between bonds and equities. I talked about it on the RRG, but here's the chart. So here's your IEF, your 7 to 10 year Treasury bond ETF, with the relative strength against SPY, and there is no doubt about the message that this chart is sending. You should be in bonds and not in equities. I have to admit that this relationship was turning around, and roughly here, just in the beginning of October, when it just broke this trend line and momentum started to improve, I wrote in one of my blogs that I was favoring bonds over equities. But at that time, I was assuming, or maybe I was in the hope camp, I don't know anymore, that IEF was going to break below 99. So yields were going to go higher, but IEF was just going to go down less fast or slower than SPY. So it was still going to outperform the equity market, but for different reasons. And what we've seen here is that 99 support has held up. We've broken this declining trend line, and now we already broke out of this, well, what do you call it, trading range. I don't think it's a double bottom, but anyway, it broke resistance, it broke double resistance. So the way is now up for bonds and for yields going down, and that's just speeding up the process of bonds outperforming equities. So if we quickly browse over these charts, this is utilities. That is one of my better sectors, the ones that I really like. Why is that? Because we are trading at almost all-time highs. We broke out this overhead resistance, formed a new high, and we are still trading above it, which is good. And we managed to turn around this relative strength line. Both RRG lines are pushing higher, which means that we're moving in a northeastern direction, which is strong. So utilities are still one of the strongest, maybe even the strongest sector at the moment. If we go to real estate, especially the relative is very good. You see a very steep angle on the RRG lines. The price chart is dropping back, and we're going to see that with more of these sector charts, that the relatives are sometimes very good for the positive ones, but the price chart is not confirming it. And that is where I always tell people that in markets like this, relative strength will separate itself from price strength and price analysis, because relative strength makes sectors like real estate and utilities surface, and this is where you can park your money as a safe haven. Again, it doesn't necessarily guarantee that you will have an absolute return. It's just telling you that it'll outperform either your balanced index or SPY, if that's what you're looking at. So for real estate, on a relative basis, it's one of the better sectors. We go to staples. That is the sector that I think started this rotation to defensives. Staples was one of the first to turn around, was one of the first to move from this downtrend into this new uptrend. And what we've seen here is that the RS ratio now is at an extremely high level. It's at the highest level of the past 4 or 5 years. So, I mean, it isn't surprising that it's starting to roll over. You see that the RS momentum is starting to level off and roll down. That's what we've seen on the RRG, where we see this tail rolling over. But this relative strength line is bottoming out. It's moving higher. So if staples have been leading defensives, then it's now time for probably utilities and real estate to take over and take the lead in the rotation to defensives and give staples a little bit of a breather. And we can see that because it's now breaking below that short-term support level. It could actually go all the way down to 48 and maybe still outperform the S&P 500. If we go to healthcare, that's another one. Healthcare and staples been doing really, really well. You see, healthcare started to rotate into the leading quadrant back in August, I think that was. What we've seen is a tremendous increase in relative strength, together with staples that led the market into the defensive sectors. But if we look at the price chart, that is not looking very good. We have completed now, or well, when we close below this support level tomorrow, Friday, which is very likely, I think, we've completed that double top pattern, which means that our upside potential is now much less than our downside risk, which I would call somewhere around in the 77.5 area. Again, from a relative point of view, this is probably still of the one of the better sectors that you want to look at. So this was the leading quadrant with the relatively good stuff. So if we now move to improving, where we see materials, and there you see immediately what I mean. I said that it was at very low RS ratio levels, and if we just eyeball this relative strength chart, this is still in a downtrend, and that's why the RS ratio is still lower. An RS ratio below 100 means that it's in a downtrend. That green RS momentum line is tracking the pace of that downtrend, and that's what we see here. We see this downtrend sort of leveling off, moving slightly sideways, recovering, but it has not broken that downtrend. So this relief of relative momentum above 100 with the RS ratio line way down is usually very short-lived, because it needs a lot of momentum to pull this red line all the way up to 100, i.e. drag XLB towards crossing over into leading. I think that's very unlikely. So I would put my money on materials rotating, maybe just, improving a little bit in relative strength, but then RS momentum will start to roll down, and we will again see an acceleration in materials going down. And this break below support here is just confirming that downtrend in price. If we go into the financial sector, really important, really big, that is not a good chart. The price chart is not looking good. All these highs are lower. All these lows are lower. So far, the breaks have been rather shallow, but now we see an acceleration. After the break below that 25 level, we see an acceleration, and the first serious level of support is only just above 22. More importantly, the relative strength line is breaking below its previous lows, and I think that this RS momentum line is ready to cross back below 100, and we'll see that here on the RRG chart, and it will drag XLF back into the lagging quadrant and again send us a period of relative underperformance for the financial sector against the S&P 500. Now, inside the lagging quadrant, there is a lot going on. This is the communication services sector. That price chart does not look good. We just broke support, like we broke support on a lot of charts. We did the same with relative strength. Here you see another one of these scissor moves, as we've seen with materials. So it's going up, but it's going up almost vertically. So it means that it's a momentum-based move. Materials had a little bit of improvement in relative strength. Communication services, well, only marginal. And that's what happens when you see that relative momentum is rising relatively steeply. And basically, the only thing that it does is is lowering the pace of the downtrend and maybe dragging it up a little bit before it starts to turn down again. It just needs to digest this first bit of loss of relative strength before it can once again roll over and accelerate, especially if we see a break in relative strength below this level, which is just above 0.16. I'd expect relative strength to rally lower. Well, it's not rally, to accelerate lower again. So communication services, still very, very careful with that one. And now we have energy. That is, I think it's probably the weakest together with industrials. Why is that? Relative strength breaking to new lows. We see RRG lines, RS ratio way down. We've seen this little scissor move where momentum rallies, relative strength ratio declines. And in this case, the RS ratio didn't even make it above 100. It already turned again while it was below 100, and that created that hook that we just indicated on the RRG chart. And what's happening this week is not going to help us either. Breaking below that mid-2017 low is very likely going to send the energy sector lower. Technology. We all love technology, but technology is out of favor probably somewhere since the summer when it started to break down here in price and it started to roll over in relative strength. And we saw the momentum already going below 100 somewhere in July, August maybe. It entered the weakening quadrant, but because it was so far away from the center, it needed a long time to roll over. And then a couple of weeks ago, it entered the lagging quadrant, accelerating the relative strength here. And we are now getting a confirmation of this down move on the price chart as well when it broke below that 62.5, I think, level. There is this little, well, what should we call it? I don't think it's support. That's around 60, but that's just a single low, a single intra-week low. So for me, the real support level was here around 62.50, where we have a number of lows lining up. And then we've got this 60, which is only just one little touch point. I don't think it'll be very, very major. So there is serious downside risk for the technology sector still. We may see a little bit of a bump up on the relative because it's now at the lowest level since the past 5-6 years. But all in all, that is still a very risky sector. Industrials, together with energy, the weakest sectors. The chart tells the story. I think this is a massive double top that has been completed. So if we look at 80 versus 70, that's roughly a $10 target below 70. So that puts the target around 60. I think real support is only found, well, if we're lucky, around 57.50, and otherwise it'll be 55. So that's still a decent way down. But more importantly, your upside potential is very, very limited initially to 67.50 and then 70. I don't think it will go beyond 70 in the near term. Relative strength just confirmed this downtrend. It rotated back from improving back into lagging, and there is plenty of room for the industrial sector to test its new relative lows. Then we have discretionary, being very, very good in the beginning, rolled over. We've all seen and discussed the breaks here. I think the break below 100 was very important. We're now resting around 95, but again, just like the single touch point, we have two intra-week lows here, which I don't necessarily think are real support levels. For me, the real support is where this whole cluster of lows of these weekly bars is hanging together with the 1-2 here, and we actually broke that level. So again, the upside potential at the maximum, I'd say $100, but the downside risk is massive. You go all the way to 90, where you see your first intermediate support level, and look at the relative that has just rolled over. Very gradual rotation. We started to get the first signals already in April, then in August again, and now we comfortably entered the lagging quadrant sometime in October, and we're now pushing further into it. And I think then we have one more as that. This is where we go into the individual stocks. 5 more minutes. Oh, that's pretty good. Exelon is a stock in the utility sector. So why did we pick that? I'm going to show you the chart of utilities. If you look at my DITC blog that I wrote today, I mean, this is the chart that you bring that you get when you bring up XLU. So I immediately ticked off that PCG thing because that is completely deteriorating the chart. And that leaves with a few chart. There's actually a whole cluster here that's looking pretty good. It's SCG is way on the way. NRG, ES, DUK, they're all heading higher here. They're looking pretty good. The one that I picked because I really liked it was EXC, and let me highlight that. And the reason why I'm highlighting that is, I'll show you, is because it was very good, and then it entered so it had its first run up, then it entered weakening, and it rolled up, and it's now going back into leading again. And that is what we see here. It's been a very strong stock in the utility sector already since August. It's been above it. The RRG, the RS momentum line has been hovering around that 100 line, creating this rotation from leading to weakening and back. So that's the indication of a very strong trend. That's what you see here. And now we're just coming back out of weakening, pushing into leading again. So, and if you look here, you can see this is a little bit of overhead resistance. If that breaks, you got an acceleration in relative strength. And this uptrend is just still doing very, very well. So I think inside utilities, EXC is one of the stocks that you might want to concentrate on. I already mentioned my DITC blog of today, and I said I'm going to pick one stock per sector. That's right. But in utilities, which is a good sector, you may want to avoid EIX because of this. This is a super long tail, very, very weak. So I'd be very careful. So even with an outperforming sector, there are still stocks that you might want to avoid. And in the utility sector, EIX is one of them. That brings me to the real estate sector. So we're going to bring up the real estate members. And this was my last week's DITC pick. That's well. Oh, well. And again, this is one of these stocks that came out of leading, rotated into weakening, and then picked up. And I like those because it means that you're not, picking the first turnaround, because when a trend, when a big downtrend is going through the process of bottoming out and starting a new uptrend, that's always a little bit tricky because sometimes that doesn't really work out. When you have these situations where something is coming out of leading through weakening and then go back up, and especially if you then check the chart that comes with it, always check the chart. And then you see this, and this is what I liked last week already because it broke to new highs, and this overhead resistance here between 70 and 72 is a massive overhead resistance, and we managed to break that in a market that was going down, in the general market that was going down. That basically confirmed this strong relative trend, and you see here that this scissor moved the other way around where momentum was falling and relative trend was just rolling over a little bit, and then momentum picks up and we pick up here. This just continues. So the only caveat that I would like to make here is that we should probably hold above 70, which was the top of this trading range. But then Welltower could be doing really, really well in a market that's going down. So from a relative point of view, this is a super strong stock. Now down to the lower left-hand part of the sector rotation where we have the energy sector. So that's XLE. Let's see, in there, I picked the weakest of the weakest. So we can call these the BOP and the WOW. So it's the BOP is the best of the best. That's what you find in the top right-hand corner, and the WOW is the worst of the worst. And NBL is Noble Energy. And I guess you can already guess why that is one of my favorites in a negative way. It started to roll up. And look at this this is very typical for momentum recoveries. It's almost vertical. So the relative trend is not necessarily improving. It's just losing a little bit of its strength, its downside strength, and it's picking up. And then all of a sudden you see it hooking down. You get one of these hooks. And if you look at that on a daily RRG, you will see a nice rotation either on the left-hand side or through all 4 quadrants. And then it comes back and you see this increase between the little dots. That's an increase in strength. And in this case, it's an increase in negative strength. So if we bring that to the price chart, then ta-da, you got one of your worst nightmares. I mean, you got this very, very strong support level around 2250, very long-term support level, and then you break down, and the same happens in your relative strength. Your RS momentum is barely able to go above 100, and you see this going down. So get out of it. I mean, don't even think about this. It's one of the weakest stocks in there, and there's a few more. You can look for yourself. If you call up this RRG, look for the ones that are moving from the top right to the bottom left in almost straight lines with increasing distances. That's the stuff that you should avoid. And then the final one for me is in industrials. That's here. And the one that I picked as the super duper weakness chart is, what was that? FTV, Forte. Why is that? That's here, and because it just moved into the lagging quadrant, and it probably means that you have a lot of downside left for this one. So if you're still in it, you might want to consider selling it, especially when you look at this price chart. This stock is not there too long ago, but this was a very important support level, somewhere around 68, I guess, 68, 69, these lows here. If we use a very thick edding marker, it probably touches 70. It's well below it. Relative strength is rolling over. We've had our outperformance. It entered the lagging quadrant somewhere, well, a couple of weeks ago. I don't see this recovering. If it recovers, it'll be probably maximum of 70. And I think that would be a good point to get out. So I'm looking at this with a seller's eye instead of a buyer's eye.
Yeah, I was just going to say, looking at that chart, Joyce, it looks to me like FTV's breaking down on a head and shoulder pattern too, off of that top.
Yeah, it's not totally symmetrical, but it definitely has the characteristics. You're right.
Yeah. So I know we're going to get to the poll here. I don't know if you have any others. Go ahead and get ready to wrap up here.
No, this was it. This was it. 50. You said 18 or 10 to 1, and it's 8 to 1. So I'm doing very well here.
Yes, you are. We have
all the time.
We do have one question I wanted to see if you get an answer for. I think I know the answer, but question is, where is your sweet spot on the RRG graph? And I know you and I have talked about this before, that you don't necessarily buy based on an RRG chart. No. It creates interesting opportunities, and then you go look at the charts.
Yes. Well, I mean, I think that following my comments and the stocks that I picked, I think that you've seen that the ones that I like are the ones that are, okay, let me put it like this. If you're very conservative and you want to be, well, as far as you can be sure in whatever business we do, but if you want to be sure that the trend is established and you want to take part of that trend, then for the buys, you look inside the weakening quadrant and they roll up again. So that's for your longs or your outperformance if you're benchmarking yourself against, for example, SPY or something. And on the sell side, it would be the stuff that's in improving and rotating back down, because you get a little bit more certainty that you're on the right side of the trend. I mean, in Arthur Hill's terms, you'd be on trend.
Yes, got it. Okay, well, we've got the poll up on the screen, and we got a lot of respondents here. And it looks like, and this is what I would expect, that more than half, so the majority, use the S&P 500 as their benchmark when they compare their portfolio. I would say that's what I use as a short-term trader. There's no point in me trading if I can't beat the S&P 500, because I just should put my money in the SPY and go play golf.
Yeah.
So that's kind of the benchmark I use. Erin, what do you think?
Honestly, I look at absolute return. I watch what my stocks are doing on their own versus each other, not necessarily the S&P 500. So I'm always looking at my gains as I go along.
You know what? I think this is super interesting because almost 60% of the people online say that the benchmark for their portfolio is the S&P 500. What they are implicitly saying by stating that the S&P 500 is their benchmark, that they are okay with losing 10-20% of their money as long as the S&P is losing more than 20%.
Right.
That's what you're saying. When you say that the S&P 500 is your benchmark, it implicitly means that you are prepared to lose money as long as it is less than the S&P 500. And I think that if you really talk to a lot of these people, that might not be the case, that they might not be willing to lose 20% of their portfolio, even if the S&P drops 25 or 30%. So that's why I asked this. I came by the way, guys, this poll was mine. I created it because I suspected this. And the thing is that my take, and Tom and Erin, you can tell me if I'm wrong, is that our audience is primarily retail investors. There are a bunch of professional advisors that we have in our audience, but primarily it's a retail-based audience. And the super big advantage that retail investors have is that they have no problem. They have no one looking over their shoulder when they put everything in cash. If you're in a pension fund or an asset management company and you're running a US stock market fund, you cannot simply put everything in cash, even if you think the S&P is going down, because people are paying you money to invest in the S&P 500. And that's the big difference between professional, pension fund, asset management portfolio managers and retail portfolio managers who manage their own portfolio. They got the big advantage that they can move into cash. So I'm super happy. I mean, the S&P 500 is a great benchmark. No problem. If you can beat it, even better. And as Tom says, if you can't beat the S&P 500, there's no, what's the use of trading stocks at all? But you got to be prepared. If you say that the S&P 500 is your benchmark, you got to be prepared that your portfolio is going down with the market, and you should be very happy when you go down 10% and the S&P is down 20%. You should be thrilled.
You raise a great point, Julius, because I didn't even think about it till you brought that up. I would say that my benchmark is the greater of.
You're changing the rules during the game, man.
Yes. I would say it's the greater of the S&P 500 performance for the year, or zero.
Or zero, yeah. That makes sense. That makes sense.
Because I don't accept losing money. I don't care what kind of market I'm in. If I'm losing money, I'm doing something wrong.
Yeah.
So,
I don't think anybody accepts that.
Well,
if you're a professional, you have to accept that.
You have to.
There's just no way that you can get out of all in cash. But for me, because I've been working with a lot of professionals, and now, for the past 4 years that I'm working with stock charts, my mindset has, it didn't change, but it focused me, and I learned to focus on the fact that we have now an audience which is much more absolute return orientated. But a lot of people have difficulty understanding what relative strength and what benchmarking against relative strength actually means. And so when you translate it into portfolio results, then all of a sudden it's but that was not what I meant.
Right.
So I think that I'm gonna put more emphasis on this because I still think that a lot of people just don't realize. We all look at relative strength and we like it, and it's a super useful tool. And even if you're absolute return orientated, it definitely makes sense to look at relative strength. Okay. But the finesse of it sometimes is not quite there.
All right. Well, it was a great presentation. I think this is definitely a thought-provoking poll, but let's get on to the 10 and 10 because we got a great segment coming up
Go
on
ahead.
sound off, and we want to make sure we get to that. But let's go ahead and switch over. We are going to jump right into the 10 and 10. The first stock, I believe, Erin, was United Rentals, correct?
URI, indeed.
All right. So I'm actually just finishing up the annotation here. And I will share with everyone my chart because this is in a very bearish pattern, I think. All right. Here we go. Okay. United Rentals, URI. First of all, you got a downtrend. You got a bounce. You got a test of support. You got another bounce. This is a classic descending triangle. You could call it a bear flag, but really descending triangle. Point A, B, C, D, E, breakdown, rising volume. We come back up, get through the resistance area, but fail at the 20-day and start to roll back over again. I don't like this chart. I think it goes lower.
All right. There were two most popular in the chat room. Somebody cheated and put 2 in one of them. Everybody voted for it. They're both shorts. So let's start with the S&P 500 ProShares short, SH.
All right. Well, again, if you think it's a bear market, the great thing to be in. There is going to be a lot of volatility. So the market will have, even if it is a bear market, we're going to see bear market rallies, and we're going to see the SH pull back during those rallies. So, this is just kind of the flip side of the S&P 500. We broke down recently below about 2580 on the S&P, and we broke out on the SH. I think if we have a bear market rally, I think it's very possible the SH pulls back to about 30 and a quarter or so. And at that point, again, I'd rather watch it on a day-to-day basis and see exactly what's going on with volatility index and so forth. But I would say maybe something to look for would be a pullback somewhere in that 30 and a quarter area.
All right, excellent. And the other one that was on that request, very similar, is the SQQQ, which is the ultra short of the NASDAQ 100.
Well, you're looking at the same thing. I think you want to follow the underlying index, though, to make your calls on the SQQQ. I would also realize that there is erosion in these leveraged ETFs. So even if the NASDAQ goes down over a period of time, you're not going to perform nearly as well as you think you might by holding this long term. So this would be a trading vehicle for me short term. For instance, if the NASDAQ gets a bounce and we get to a level where the VXN, the VIXN, which tracks the NASDAQ 100, were to drop back down, say into the teens, upper teens, I think that would be a great time to take a shot with something like the SQQ. But again, follow the underlying index. I would really pay attention to the NASDAQ 100 when I am trading a leveraged ETF that tracks the NASDAQ 100.
Okay. Let's see. Next one is from Healthcare Pharmaceuticals, Eli Lilly, LLY.
Yeah, this is in the pharma space, which is very defensive. These types of stocks tend to do much better on a relative basis during bear markets. Eli Lilly did raise their guidance yesterday. I think it was revenue guidance. And you've got some pretty good support, I think, down around these lows dating back over the last 3 or 4 months. So I think anything down around 104, 105, I think you could have a very tight stop. I think Lilly's a good long candidate in a bear market because I do think it will outperform. But if the bear market continues, most all areas will move down. I think Julius was mentioning this earlier. Just because you see something outperforming on a relative basis doesn't mean that it's actually making you money. And so you want to pay attention to the support levels. But I think that this is a stock that will outperform the S&P 500 in 2019.
All righty. Let's look at a FANG, Netflix.
Oh, not a lot to like on these charts. I mean, the move to the downside is slowing. We went down, hit support. So, but you can see that the lows just keep moving down. The highs keep moving down. I think it's just a matter of time. If this is truly a bear market in 2019, we have not seen the bottom on Netflix yet. So I think that is offering up good support in the short term. But I think from a longer term perspective, we go lower on Netflix. And I would probably maybe just draw the line here for these recent lows. I think for now, we're probably somewhere between 250, 270 trading range. But I think the next move is going to be down.
Okay. Let's see. Next one, the only technology and another FANG. How about Apple?
All right. Apple also not excited. I will give your dad, Carl, some kudos. I know recently, probably not that recently, maybe a couple months ago, month and a half, 2 months ago, I read his article about Apple and the fact it was rolling over and could go a lot lower. And that was a very, very timely article. Apple has been hit hard. You can see the volume has been very strong on this move to the downside. I don't think we're over yet. And you can see positive divergence is moved to the downside, positive divergence in terms of the PPO, but the volume has not been light. I do not see this as slowing momentum at this point. Yesterday's move to the downside accompanied by heavy volume again. I think at best, at least in the near term, would be a trip back to the 20-day. If we get a big bounce in the market, maybe Apple gets back to its 20-day moving average, but I'd be a seller there.
Okay, this is our Canadian friend's request in the materials, precious metals, YRI.TO, Yamana Gold.
For the most part, I like the gold stocks. Now, obviously, this one's been struggling. We went back below the 20-day yesterday, but now we've gotten right back up above it. We're starting to see a little bit better overall volume trends, and I like the group. So I'm gonna give this a very real tepid little buy on the stock. And just if it were to close below yesterday's low at 290, I would be watching it really closely. I probably would be out of it. So that to me is going to be pretty key. Because if this was just a little head fake below the 20-day, you can see the 20 starting to rise now. And we've also gone positive on the PPO. We've seen that before, this same type of setup back in October, and we've rolled over. That's why I want to keep my stop in play. But I think given that the market is so fearful and gold is beginning to perform well, I'm going to give this one a shot to get up and break out above this 320 level. And that, to me, would be a really bullish sign. So for now, let's call it 290 to 320 trading range. But what you really want to see is a big volume breakout above 320.
All right. Our only consumer staple, and I suspect on a relative chart, it's certainly not performing like its sector. ConAgra brand, CAG.
Yeah, this one was, we went over with the earnings. I mean, the stock's just getting absolutely hammered today. Big volume, 15%. Yeah, it's getting oversold. We're probably going to get a bounce at some point. Where we get a bounce, very difficult to say. But I would just say, number one, that 20-day moving average at some point will get tested. And to the downside, I mean, this is what I was talking about when I say oversold. You get an RSI that's down below 30, in this case down to 14. You don't see RSI readings at 14 very often. We've been oversold now for the better part of 2 weeks. It's definitely due for a bounce. I think this is capitulation type move. Where it bottoms, though, I'm not quite sure. But I would be expecting a bounce probably in the next day or two. Not a huge bounce. I think that there's a lot of folks getting out. So I think if any kind of a bounce, we'll see more sellers coming in. I would not expect an immediate move back up to the 20-day. I think instead maybe a little more muted response with the 20-day continuing to decline.
All righty. Let's see. No, we've got two more. Angie's List. ANGI.
All right. ANGI. See what ANG looks like here. ANG doesn't look very good. We are down testing some support from July and August. Stretch this chart out just a little bit longer and see if that's actually meaningful support. No, not really. I mean, I think this support down here is probably more important. So I'm going to draw a trend line or a support line coming across. You can see how many times we tested this coming across at 13, then we broke out. I think with a negative divergence at the top and now trading below that 20-day moving average, I think it's working its way all the way back down toward 13. I'd avoid it.
All right. And the last one is ultra short real estate.
What's the ticker on that?
Oh, I'm sorry. SRS.
Okay. Actually, I should have remembered it. I just haven't seen it for a long, long time. Mm-hmm. This is, again, you're going to want to, I'm not sure what the underlying index is on the SRS, but you want to look at the underlying index. I'm not a big fan of the leverage short on real estate. This is a defensive group that should do better than other areas. I mean, if you believe the stock market's going down, and you want to do ultra shorts and leverage, I think there are going to be other areas that are going to be better to trade. Obviously, just looking at this chart, again, I would look at the underlying index, not this chart. So I hesitate to annotate. but you can see that the SRS did top out just above 31. So if I was in it, I'd at least be looking to the underlying index and see what happened back here in mid-October. If we're moving down and we're testing a key support level, then I would be making sure I get out of the SRS, take my profits.
All right, and that is 10 in 10. Actually, much less. Great job. And here are the symbols. I will have those up in the Market Watchers Live chart list. All you have to do to get to it is go to the blogs tab, click on Market Watchers Live blog, and the link is at the top. You can also save those charts to your own chart list if you like our style of charting. All right, time for our final market update. Let us see what is going on, and then we can get started on our last segment. All right, as we can see, markets are down. We had a little bit of a rally in the morning. Looked like we might be able to get to the positive side. The S&P actually touched a little bit above yesterday's close, but we are now headed back down. Looks like we could be, stalling out right now. The NASDAQ is forming a little bit of a, well, it looks like a flag. So we're getting these little consolidations at the bottom of these declines. Same for S&P 400, Russell 2000. Looks similar as well. I don't like the shape of these intraday flags. We'll have to see how that pans out. Canadian markets were up this morning, and I suspect the U.S. markets have had managed to drag it down, and now the TSX is in the negative, down, oh goodness, 0.66%, 0.2%. Treasury yields are down, currently 2.769%. The VIX is rising. Wow, we've got readings right now above 28. So we are seeing some very high VIX readings, lots of nervousness out there. UUP, big gap down, tried to make a comeback. It took back almost half of the losses, but now it has gone back down and has set a new intraday low. Gold, on the other hand, pretty much the opposite. We're seeing a huge gap up to yesterday's intraday high, and we've managed to trade mostly above that, currently heading straight up. GLD is up $2 to 119.43. USO is traveling slowly downward as we continue to watch it fail. Now we're reading it on USO under $10 at $9.73 for USO. TLT is up on the day, mostly consolidating sideways, reading 121.67. That's all I have for my final market update. Pass it to you, Tom.
All right, I just want to point out consumer discretionary is the weakest sector today, down 2.5%. I wrote in my blog this morning that this is the one group or one of the few areas that was still clinging to support that was established back on that high volume sell-off back in early February. Well, it looks like that is about to give way, and you can see the declining 20-week moving average. We are now getting across to the downside, which doesn't happen very often, and you can see all these failures have been taking place at that declining 20-week moving average. Market certainly looks like it is behaving like bear market, and that is going to lead us in beautifully to our next segment, which is sound off. And we are going to do rapid fire sound off. We are actually, for those of you who have been in here and listened to our sound offs in the past, we each have topics that we address. We have 30 seconds to sound off what we think about that topic. Once the 30 seconds expires, our sound is turned off by our friendly director of the show. So we definitely are going to have to come up with our arguments very quickly. I will say the first topic, and Erin, I'm going to let you start it. First topic is, everybody's talking bear market. How low does the S&P 500 go in 2019?
All right. Somebody in the chat room asked what my support levels were, and I'm looking at the 2200 level here as a possibility, to make a little bit of a bounce or a bit of a comeback. But I'm looking for a drop past 2100. I'm looking for the S&P to move down to 1800 at a minimum in 2019, and I think it could go lower.
Okay. Julius, you got your turn. How low do you think the S&P 500 goes in 2019?
It's going to be at 2200, Tom. And I came at that level by taking that massive top formation that we just completed. That's 2900 minus 2550. Gives me 350 points below 2550, and that's exactly 2200. So that's the support level. That's where we're going to be in the next year.
Okay. I am going to go with 2100. I believe we are in a secular bull market. I think this will be a cyclical bear market. I do not think it's going to be a huge bear market, but down to 2100 would be somewhere in about that 27% range, which is like a typical bear market. I do think this breakdown's very significant. We're out of the trend channel. I think we go down to 2100 eventually in 2019. Okay, we are going to move on to the second question. And this time, Julius, I'll let you start. Question is, will we want coal?
Yeah, you can bring up that chart. I didn't bring up the chart. I just jotted it down. If you bring up that chart, you can go next, and then we don't have to switch screens.
Okay. I will bring up. Well, I'm going to probably take a look at it a little bit different, but I'll go ahead and start. Here is the coal index. And the question is, will we want coal in our stockings? In other words, do we think it's going to go higher? I'm saying no, I don't want this in my stocking. I think it's below the 20-week moving average, trending lower. I think we're going to go back down to this key support area around 35. I want no part of this during my holidays.
I want it in my stockings. I think it's at a double support level. That 50 is a horizontal support level. It's resting at it right now. From the lower left, there is a upsloping trend line. I think it's going to hold. I think we're going to see a bounce towards the end of the year. So give me some coal, Beast.
All right. He wants his coal in his stocking. What do you think?
Absolutely.
I'll take some coal. If Santa Claus is not coming to town, I'll certainly take some coal. I agree with you, Julius. Very important area of support here at the 50 area. We could very well see that hold. I think worst case, we go down and test the low here at about 45. But I agree, you've got that nice rising trend line. I don't have it drawn.
Yep. Oh, the mean producer cut you off, Aaron. But I think
somebody had to get cut off. Come on.
Yes, that's part of the game. But I think the gist was there. Okay, question, Aaron. You can go ahead and start. We'll let Julius go second on these since we will keep the screens, the charts up for him. Mm-hmm. So question here is Santa Claus Rally. We tend to see that, and I'm just going to give you a little lead in here. Over the last 68 years, the S&P 500 from December 21st to the 31st has had an annualized return of more than 38%, which is well above the 9% average annual returns during the year. So the question is Santa Claus coming to town this year? No,
I'm sad to say it's going to be a year without a Santa Claus. That's my sense of it. We could maybe, New Year's, pop some champagne. Everybody, we get a little bit of a bounce. But when I look at these support levels, I don't see it. I feel like we're going to have to come down lower. I think good news is I do.
Oop, there was some good news. I'm not sure what it was, but there was good news. All right, Julius, you're up. What do you got?
Which town? Is Santa Claus coming to town? Which town? Because I don't think he's going to New York nor to Amsterdam, but I think Santa Claus is going to Hong Kong or to Shanghai, actually.
Oh.
What should I look at?
He's going to take his reindeer and move and head into Asia.
All the way over there. Yeah, that's probably where the outperformance is going to be.
All right. I'm going to say he still comes to town. I think that we are getting very, very close to a capitulatory bottom. It might be 1, 2, 3 days away. I'm not sure, and I'm not going to try and predict. But I will say that the put-call ratio right now is at an extreme where bottoms have come in, and we've got the VIX up at an extreme. Look for a major reversal one day. I think
Sometimes I really wish I had that button.
I know. All right. Well, I got muted. All right. Let's see. So we got another one. And I guess I will have to start this one.
Yes.
So is my screen still up?
There it is.
Okay. So the question is now the time to buy gold? I say it is. I think this is a 10-day moving average of gold. It is rising when the market's pulling back. We saw the same kind of behavior back in February. We started to turn higher on the gold when the market was weak. I think this is a normal place when money's fearful. I say yes.
Hey, nice job.
All right, Julius, what do you think? You want me to?
I actually agree that gold is going to go higher. I think we're resting at support, and I think that we will see some improvement in gold over the next couple of weeks.
Okay.
Excellent.
What do you say, Aaron?
All right. Well, let me get my chart, so don't count it against my 20 seconds. Okay.
No, it starts when your charts pop up.
Okay, this is my daily gold chart. We're at very important support. We held it. Look at the PMO. It's rising very nicely. You've got a good scooter. And if you go to the weekly chart, oh, I'm going to get cut off. But the weekly chart looks really healthy as well, maintaining a nice rising trend channel. And I would expect to see it higher.
Yep, you got cut off, but that's all right. We got the gist again. Erin definitely likes the gold trade, so that's good. All right, this time, Erin, you get to go first. So you can pull up your GE chart and tell us if GE is bottomed.
All right, let's look at GE. Okay. Actually, I'm going to put this on a monthly chart. So give me a second, guys.
I think it's counting.
No, I have to get the monthly chart.
That's not fair.
I get to my, okay, there we go. Has GE bottomed? I don't think so. I think, look at this. There's still support down here. Heck, it went all the way down in 2009, well below where we're at. So certainly you could see that. The PMO, it is
up. Okay, I think we got the gist again. Not a fan of GE just yet. How about you, Joe?
No, the short version is no, it has not bottomed yet. And for my 10 seconds that are left, I don't think that we will see bottoms like go into a bottom and then jump out of it. There's always a little bit of a test going on, so and that has not happened with GE yet.
All right. I'm going to weigh in and agree with Julius. I don't think, and Erin, I don't think we've seen a bottom yet. I do think there's a possibility. We've seen such a huge sell-off. I wouldn't be surprised. Maybe we could climb into that 8-9 range and just consolidate for a little while. That would be the most bullish scenario I have. I think GE goes lower.
all right.
All right. And I will do the last one. And this is, will commodities hold their 2016 low? And I don't know if I can speed this up in 20 seconds, but I'll give it a shot here. Right now, the treasury yields here in the U.S. have turned down versus Germany. I think that is the market saying that we are weakening. The U.S. economy is weakening. That is not good for the dollar. I think the dollar rolls over. And as a result, I think that means DJP holds its 2016 low. Crude oils are.
Yep. You got cut off.
Yep.
Yeah, I'll take it from here. If you leave that chart up, the 2016 low is 19.5. I think that will hold, but I do think that we are going to test it because I don't think that 2175 level that we're testing right now is going to hold. So that's going to break, and then we go to 19.50.
Hey, we finally got Julius cut off.
Yep. Everyone got cut off, but I think all of your comments, I think everyone understood. Looks like maybe a retest. Erin, you get to go last.
Yes.
DJP, pull your chart up and start the clock.
All right, here we go. I don't think it's going to hold the lows. It could. We're looking at something nice here on the weekly chart, but the PMO is super ugly. It's accelerating downward. I don't think it's going to hold the lows we're at right now. Certainly in 2017, I think we could hold 16 though.
Okay. Yeah. I would just add, one thing on that 2014, 2015 decline, actually even going back to 2012. Part of the problem was the rising dollar. I mean, the dollar was just flying back in those years to the upside. And so as a result, I think the dollar is more stabilized. And the commodities have stabilized a little bit as well, but we shall see.
Mm-hmm.
All right. Well, we've got a few more minutes left, and I figured this would be a really good time to just talk about the Fed. The Fed came out, big meeting yesterday. You can see the topics we just covered here on the sound off. But the big story really yesterday was the Fed coming out at 2 p.m. I think a lot of traders, a lot of folks on Wall Street looking for the Fed. I think everybody was expecting that 25 basis point hike. I don't think too many folks were expecting the Fed would come out and say, everything is turning down and therefore we're going to just stand pat. I didn't expect that, and I don't think most people did. But I think what most traders did expect, and you all can chime in, disagree, is that I think that the market was expecting that the Fed, Jerome Powell, would change his stance a little bit about 2019 and maybe just be a little softer and say, well, we're going to be more data dependent and we're not really sure what we're going to do. We're looking at hiking rates, but we're going to make sure the data supports that. And that's really not what he said. He said that, well, instead of doing 3 rate hikes, we're going to do 2. And I'm doing a little paraphrasing myself here. But What did you all think of that in terms of the Fed? What do you think that's going to mean in 2019?
Well, to me, I'm actually questioning the fact that is there anything he could have really said that would have given the market that boost? When you see the decline that we're having and the follow-on we're getting today, honestly, I don't think it really was going to matter. And I think we talked about how there really was a no-win situation for him.
What do you think, Julius?
Yeah, I think I have to agree with that. I mean, all this, it's a big event, or it was a big event yesterday. It's been a big event in the leading up to it. Everybody's been waiting for the Fed and listening to the Fed and what is the Fed going to do. And now it happened, and we're now, the market is now basically digesting what happened. And I tell you, in a month from now, we will not be able to pinpoint on the chart where the Fed has hiked their rate. If you go back now, if you bring up a chart of the S&P 500, it'll be very difficult to pinpoint the dates where the Fed has hiked without aligning them. So it's a big event when it happens, and the whole market has an excuse to watch someone and to respond to someone. But in the end of the day, it's a market event, and if rising rates basically means that the economy is doing well.
Mm-hmm.
Otherwise, you don't rise rates. So for the long term, that could be a good sign, because the market is healthy enough to rise rates again and get a healthy economy. The market probably has discounted too much of it already, and I agree with Erin. What should have been done to not decline? I don't think that the rate hike was the cause for the decline that we're now seeing. I think that it is used as an excuse to continue selling.
Yep.
Yeah, I would say too, and I don't know if you're aware of this, but you remember going into 2018, we had a streak of, 320 or 330 consecutive days where the S&P 500 had not seen a 3% decline. And that changed back in February. And I don't know if you know, but it coincided with Jerome Powell being sworn in. The same day that Jerome Powell was sworn in as the Fed chief, that was when we saw that first 3% decline. And I don't know, maybe it was the market saying, you know what, we now have a Fed chief in play who's more hawkish. He's not going to handhold the S&P 500 like we've seen over the past 10 years. Traders are like, oh, wow, we're going down. Let's look to the Fed. Let the Fed pump something in, give us another QE. I think the market has changed. I think David Tepper from Appaloosa Management said this really well yesterday, that the Fed is no longer going to be your savior on the S&P 500. I think that's the statement that was made by the Fed yesterday.
Sounds like Julius.
Yep. So we'll see. But yeah, you can see the clear breakdown now at this point. I don't know. This is not looking good. I do think we'll probably get to the point where, we're seeing a lot of panic at this point. Volumes are picking up. The VIX is accelerating. The put call ratio is accelerating. The problem is if you try to jump in now and you have 1 or 2 more days of this, you're going to be down a lot because the selling is impulsive to the downside. It's not rational. So we'll see, but it's not looking very good as we go into 2019.
This is when, no offense, Erin, but this is when the men are getting separated from the boys.
Yeah.
So
that's a good way to put it. I know we got to wrap up, but you have a final word here, Erin?
Just happy holidays, because I'm not going to be seeing anybody tomorrow. So watch my show, Decision Point, tomorrow, 5 p.m. Eastern, give you the wrap up of the day.
Yep, definitely check that out. All right, I want to thank all of you for being with us today. Stick with us. We're going to keep following all the news, keep you posted. And also, please remember to complete that survey as you exit. It's located below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here tomorrow. Happy trading.